Okay, team. Rare midday update today. I usually wait until the bond markets are closed, so we have a clear picture of what happened during the day. Today, can't really wait for that. And there's a couple of reasons why. Number one, the inflation cat is out of the bag. Warren Buffett let it out. And we're going to look at that here in a second. And just based on where we're trading with bonds, today makes sense. If you have the chance, if you have the opportunity, lock your rate today. If you are not in real estate, not invested in real estate in some way, it's still early because they have kept the inflation information from us because they are trying to hide it. And for good reason, it's bad. We still haven't seen the run on real estate that we're likely to see, regardless of what rates do. It doesn't even matter. If rates get worse, people will still be pulling the trigger. You can count on it because it's just so early. All we've seen is the sort of forced automatic inflation action, which is when there's too much money in a room. People start paying a lot for it. Imagine if you were sitting in a room with 5 people and you all have monopoly money, you start auctioning off items. Prices are going to get crazy, right? Because there's just too much money in the room. And that's what we've got right now. So we're seeing the effect of inflation, but not the mentality of inflation. We aren't seeing the widely known and understood, we're in a seriously inflationary situation. What the heck? We're not seeing any of that yet, but you're going to start to. And I may as well just show this first. I posted this earlier. Buffett came out, he and Munger. And what's funny with me is the guy sitting with peanut brittle on the desk. Peanut brittle. We know you're old, Warren. You don't need to put peanut brittle on the desk. So he says Berkshire Hathaway is seeing very substantial inflation. Now, remember, Buffett is a bull. He is long stocks always, not a short. He's not a bear. He likes to buy good, solid companies that have good opportunity for growth, good cash, good shape, hold it for the long haul. He likes to buy them when everyone else hates them and sell them when everyone else wants them. Very, very simple strategy. Takes lots of time, but works. He's a patient man. Substantial inflation is good for him. He likes it for the most part. Except for some of his businesses that own sensitive economies in which the inflation is going to hurt them. And so that's the only reason you're really seeing him speak out about it. He might not even say anything if that weren't the case. Either way, your boy has been telling you this for some time now. They're hiding the inflation from us. They're suppressing it. The CPI is not a good index for inflation anymore. It hasn't been for a long time. It's running way too low. Why aren't they telling us the truth about inflation? It's so obvious. Why aren't they telling us the truth? There's lots of reasons. Number one, it's a bad look, right? New president takes office. Immediately there's rampant inflation. Politics. That's one reason. Another reason, investments. Once it is widely known that inflation is rampant, certain things will happen. Number one, the bond market will get murdered. This has already started. We've been tracking this. Here's the mortgage bond market. We're going to look at the 10-year as well here in a second. I got to show you all this stuff today, guys. I know this is an early video for me, and I've got plenty to do, but I've got to let you know what's going on here. So, quick synopsis on this. This is since what are we going back to here? Let's go back to January. That's when we hit the high. So bond prices go down, bond rates of return go up, which is good if you're a bond investor to buy bonds when they're lower. But if you're wanting the lowest rate for a mortgage, you want bond prices to be higher. Bond prices going up means rates go down. We've been locked in this little trading box here, okay, for a minute. We haven't been able to break through this particular resistance level. We've touched it 1, 2, 3, now 4 times, and we got through on the 4th time, but we're having a hard time, as you see, just dropped again. We're having a hard time getting through this here. And in concert with Berkshire letting the cat out of the inflation bag, I think now is the time to lock your loan. We're right at a point of resistance. We've had a nice little run higher here. Rates did get lower. I told you this would happen. I told you rates would get lower. We'd have a moment where rates got lower. Might even be able to snag low 2s again, which we did get really close there. Mid 2s, lots of people got that. Mid to high 2s, lots of people still getting that. But then long term here, because of the inflation, which is terrible for bonds. I mean, it couldn't be worse for bonds. Inflation's bad, especially what did Buffett call it? Very substantial inflation. We're not talking 1%, 2%, 3%. He's talking about big double-digit inflation. That's very substantial. Inflation at 2 or 3% would be like, and the Fed's trying to keep it at 2. They're not. It's way worse. So very substantial inflation. With very substantial inflation being acknowledged in the marketplace, expect this to go down. Now, I hope I'm wrong. I hope that the Fed sees what Buffett said and goes, you know what? We better turn it up. Turn it. Oh, gosh, I'm such an idiot. I'm so sorry. All right. There's the picture I've been meaning to show this whole time. All right. Backtrack a little bit. Bond prices going down means mortgage rates go up. Bond prices going up means mortgage rates go down. We've been stuck in this channel here. We can't get through this level. We've got Warren Buffett saying that there's very substantial inflation, which is terrible for bonds. This is a lock situation. You lock. Now, this doesn't mean that rates are going to immediately skyrocket. It just is the unfolding of what I've been saying to expect for quite some time. The dead cat bounce off of this huge downtrend came up. Hey, it came up to the 236. It's not bad. Not bad. Normal continuation for the trend now would mean lower. This inflation thing that's being hidden from us, you're going to see more companies talking about this. As more companies, report earnings, they're going to start talking about inflationary data. Now, they can't speak about inflation in general because they can only speak about their company. Berkshire, on the other hand, owns lots of companies, lots of different kinds of companies. They own, companies like Heinz, for example, which is selling you $4 bottles of ketchup. Now, when you sell $4 bottles of ketchup at the grocery store, you're talking about production, distribution, shipping, paying for space on the. There's a lot of cost to get to that $4 bottle of ketchup. So if there's an inflation spike, if there's a 50% inflation spike, you're going to see it in that Heinz ketchup in the grocery store. Or if they can't do it because you're going to buy the Kroger instead, then they're just going to get murdered. They're just going to get absolutely spanked. So that's why you're seeing him start to say it. Why are we seeing very substantial inflation? Buffett and Berkshire are actually a better barometer, a better gauge to trust for this than the Fed or the government or any bow tie person, anyone who wears a bow tie. Any of those people, Buffett is a better person to look to for information on this because he has access to businesses who are going to really, truly be affected by it. He can see the dominoes and, and here's what he said. Okay, we're seeing very substantial inflation. We are raising prices. I'm going to make that clear. We're talking about that Heinz bottle of ketchup. It's coming. It's going to go from $4 to $6. You might not notice. You might not notice on the ketchup because $4 or $6, you're still buying the ketchup. You may not notice. But what you may notice is by the time you get to the register, where you're usually spending $150 or something like that at the grocery store, it might be $250. Then you notice, man, I can't get out of here. Has anyone noticed this lately? Man, I can't get out of the grocery store without $100. I didn't hardly buy anything. People are raising prices to us, and it's being accepted. What does that mean? That means that the people who they are getting, ingredient type goods from, certain things that they don't manufacture on their own, those things, the prices of those things are being raised to them and they're accepting it, meaning that they can't find a better solution. They can't look at a solution, well, let's do it on our own, or let's find a competitor, or they're not finding another option. They have to accept it. So people are raising prices on us. We have to accept it. Therefore, we are raising prices. That's another way to say it. So this is inflation. Now, this is what I mean by it's still early and why you're going to see years and years of real estate going higher, at least 3 or 4 years. And it doesn't even matter what rates do. Look at how many people are buying in cash right now. Look at how many people have huge down payments. The rate's not going to matter. It's really not. And yeah, it may be tough for some people to live in San Diego with prices going higher and rates possibly going higher. By the way, lock your loan today. If you can, lock it. I've got everything locked. Anything new comes in, we're going to lock it immediately. This is just a situation where you have to do it. We will absolutely pull the trigger right away. Now, this little gift here of lower rates is really, I think, the best gift possible for people who, have been looking for a long time and finally get into escrow. This is a great gift for you. There are a lot of people who got in on their first or second offer. They're just getting a great rate. Terrific. Love it either way. I don't see us making it through this level here, not with the inflation cat out of the bag. And when we find out what the real inflation numbers are, there's a very good chance these bonds will sell off even harder. The Fed will not be able to hold them up, and you're going to see rates go up. I do not think that stops the buying of real estate. The reason is because when the inflation cat gets out of the bag, which it's really, really is now, what are people going to do? What are investors going to do? We already know what Wall Street's been doing. I mean, that's how this got from here to here. They know. People are probably going to sell bonds. They might buy stocks. That's possible. Stocks are pretty highly valuated. But they also, most likely, will buy real estate. And not just people. And this is the thing that's hard to grasp. It's not just people who are going to be buying real estate. It's funds, hedge funds, pension funds. We're going to circle all the way back to what happened before the crash, where real estate is going to be collateralized for sure and sold again. And it's going to work again for a long time. We might just see an exact repeat of what happened last time. That might be 10 years from now. But, we might crash down to prices that are 25% higher than they are today. But we're going to see another big move in real estate over the next 3 or 4 years at least. Because big money is going to come in on this side too. Do you know how much money there is invested in the bond market? It's 100 times bigger than the stock market. And if the bond market is ready to take a dive, and let's look here. So one cool thing about Barry Habib's site here, which is what we're looking at, mbshighway.com, we've also got the 10-year right here, which he tracks, gives us indicators, does the Fibonacci's for us. Really, really cool. You can get this on other sites too. This one isn't as exclusive as the mortgage-backed securities is. But let's go ahead and let's just look at what's happening here. You have, pretty much a pretty basic sort of slight downtrend here. And this is the 10-year. And this is different because we're not looking at the price. We're looking at the yield. So right now, the 10-year is yielding a little over 1.6%, which is pretty good compared to where it's been. But that just shows you that rates have gone up, right? Because if you track the 10-year, take that back to January as well, comparing apples to apples, look, you can just see rates going up this whole time, right? They've leveled off here. We have a little box here that we've leveled off in. But then if you also look down here, there's a squeeze happening. And this is technically called a rising or a converging wedge, I believe is the technical term, a converging wedge. And so it's likely to break out one way or the other. Which way does this look like it's going to break out to you? We have the 50-day moving average here. We have a 236 Fibonacci right here. We have a downtrend line right here. We have the weaker 25-day moving average on top. And then the slightly longer but slightly more flat trend line above as well. So we have 3 pieces of support that are stronger than the 2 pieces of resistance. I mean, it just looks like this wants to go higher, which would obviously be rates going higher. So if we look at that as a trigger as well, it's also there. Another thing that we've been tracking, oil rise to 67 as demand hopes counter India concern. There's a concern with India. This has actually retreated quite a bit back to 64.5. You got Brent still at 67, but oil continuing to go higher. Watch as we continue to see this march toward $100. Oil is going to head that direction because the economy is going to open up. As you see here, right on CNBC, Florida governor suspends COVID restrictions. We are no longer in a state of emergency. Florida is pretty much wide open, has been for months. Other states are going to follow suit. I believe we're going to see something happen in California this summer as well. Vegas is, Nevada is happening. When the economy reopens, there's going to be a big surge, a big demand. You're going to see oil go way up. You're going to see a lot of things happen, but money's going to shift. Right now, you see right here, same page, demand outpacing supply for new vehicles. Why that's bad for shoppers but good for investors. Well, it's good. I would sell your car stock so fast. If you own a car stock, and I don't know many people who do, I would take that money and get the heck out of there, because you're never going to see a situation like this with cars again, I don't think, where you have such rampant inflation and don't have any other options. That's the thing. Right now, because people can't go out, or haven't been able to, a lot more big ticket items are being purchased, including real estate. When things reopen up, I think some of those things, and I think cars will be one of them, will suffer, because there's going to be other options, entertainment options people are going to be looking at. People are going to be looking more at buying the house is going to be more important than the car. And I think you're just going to see, that cool off quite a bit. It would make a lot of sense if it did. But the economy is going to resurge. There's going to be a nice little spike. The Fed has been telling us that resurgence is a temporary spike in inflation. You're going to see inflation spike temporarily due to the reopening. That's all cover. It's all crap. All crap. So lock your loans today. Hope I'm wrong. Hey, I hope I'm wrong, just like everyone else probably listening to this. I hope I'm wrong. I hope that this just shoots higher, comes right up here, blasts through all this, and we go see, new lows for mortgages. That'd be terrific. I would be very, very happy about that. I just don't think that's what's going to happen. So be ready out there. Everything we've been talking about the last couple months seems to be coming to fruition. It's nothing to be afraid of, but it is something to be informed of. So stay informed, stay clued in. I will keep you posted as much as I possibly can. Sorry for the bad camera work earlier. Do my best here. I am just a high school production at best these days. If you know anyone who has questions about the VA home loan, whether they want to buy or refi, have them give me a call, shoot me a text, send me an email. Love to help them. That's what we do. We help veterans buy homes, refinance, get great deals on their home loan without a haggle. They don't charge any lender fees. We have great rates. That's the whole design and purpose of our existence here in the VA home loan space. We're trying to break the trend of veterans being taken advantage of, taxed, charged high rates, charged a bunch of fees. We're trying to break that trend. We're trying to make it good for veterans to buy and refi again. So refer your veterans to me and I'll take great care of them. You can read my reviews online. You can see exactly what's going on there. So hopefully that helps everybody understand what's happening in this market. Buy real estate. Maybe the new slogan will be buy real estate before it's too late. My worst fear has always been that Wall Street, big money, whale money will come in, government money will come in and buy real estate, and there will be no way for the average working family to buy a house because the prices will be too high. This is actually the perfect setup for my worst case nightmare that I've been talking about for 10 years since the last collapse, that one day it would set up in this way, and that 100 years from now, people will be telling their children, "Oh, I owned a home." And the children will be going, "Wow, what's that? How? You mean you didn't pay your housing payment to the landlord, government, whatever?" I'm not trying to create fear with that, but I'm just telling you that's my worst fear. That's my worst fear for everyone in this country, that you don't have a chance to own a piece of real estate. And the more prices get inflated, the more that becomes reality. The more that we see just crazy, and not just in San Diego or Southern California either. This is happening all over the place. And that's what has me the most concerned about it. Okay, team, have a great day. Hopefully that's helpful. I'll be back at you soon.